Welcome to Nexus Deep Dive. Today, we confront a volatile nexus of geopolitics and global finance, the escalating tensions between the United States, Israel, and an embattled Iran. The specter of conflict looms large, carrying with it the very real risk of an economic earthquake, primarily in the form of an oil shock that could reverberate through every corner of the global economy. As investors, it's easy to dismiss persistent regional unrest, but the current confluence of factors suggests that ignoring Iran's precarious situation would be a profound miscalculation. The precarious state of Iran, a powder keg awaiting a spark for the first time since the 1979 revolution, the survival of Iran's regime appears genuinely imperiled. Mass protests, numbering in the hundreds of thousands, have gripped the nation, met with brutal repression that has claimed over 2,600 civilian lives and led to thousands of arrests. Internally, the Iranian economy is in freefall. The rial has collapsed, inflation is soaring, and GDP growth and imports are plummeting. The regime's credibility is shattered, further exacerbated by the imminent succession of 86-year-old Supreme Leader Ali Khamenei. This internal fragility makes the regime unpredictable. Embattled leaders, facing existential threats, often resort to desperate measures. BCA Research's Matt Gherkin estimates the risk of a global oil supply shock if the regime crumbles at a high 40%. President Donald Trump, recognizing this vulnerability, has threatened very strong action against Tehran's repression. His approach to foreign policy has notably shied away from the nation-building failures of the past, exemplified by Iraq and Afghanistan. Instead, Trump has favored targeted interventions: the destruction of Iran's nuclear program in June, the assassination of military leader Qasem Soleimani in 2020, and the recent removal of alleged drug traffickers in Venezuela. His success in Venezuela, in particular, may have instilled a dangerous overconfidence, fostering a belief that similar tactics can be applied to Iran. However, Iran is not Venezuela. Its capacity for retaliation is far greater, posing significant risks to U.S. regional interests and global stability. Trump's options: a spectrum of risk and retaliation. The Pentagon has laid out a multi-tiered strategy should President Trump opt for military action, categorized into three buckets of capabilities, as detailed by James Stavridis, Dean Emeritus of the Fletcher School. The first bucket involves non-kinetic warfare. This includes sophisticated cyber attacks to cripple military and civilian targets, information warfare to sow dissent and provide alternative information channels to the Iranian populace, such as Starlink terminals, and advanced radio frequency tools to degrade critical systems, a discombobulator weapon, as Trump alluded to regarding Venezuela. While these options avoid direct physical destruction and minimize civilian casualties, their efficacy in coercing a deeply entrenched regime like Iran's is questionable. The second bucket encompasses limited strikes. This is the pathway Trump has most often hinted at publicly. Such an operation would involve strategic attacks over 1 to 2 days against military targets, ballistic missile batteries and production facilities, command and control hubs, especially those of the IRGC, and potentially even leadership targets. These strikes would leverage Tomahawk missiles, drones, electronic warfare aircraft, and stealth fighters like the F-35. The objectives here would be to demonstrate overwhelming U.S. air superiority, neutralize Iran's key offensive weaponry, particularly its ballistic missiles, and degrade its ability to threaten critical shipping lanes like the Strait of Hormuz by targeting naval assets. The financial market's reaction to the nuclear program strike last year, a 30% rise in Brent crude followed by a decline, and a modest 14% rise in U.S. energy stocks, suggests that contained, strategic strikes might lead to a temporary spike before markets calm down. Treasuries, in such a scenario, would see little bid as the risk of escalation fades. The third bucket, the truly big tools, entails full-scale military action. This would involve several weeks of sustained strikes aimed at wiping out multiple levels of Iranian leadership, destroying remaining nuclear facilities, crippling the electric grid, obliterating oil production and refining capabilities, and neutralizing naval infrastructure. Such a campaign would employ strategic bombers, B-2s, a larger contingent of F-35s, and carrier-based F-18s. This path carries immense risk, as it would likely provoke major retaliation, irrespective of the initial targets. The political stakes for Trump are high. Intervening to rescue protesters, particularly by striking domestic security forces embedded in population centers, could destabilize the regime entirely, triggering a furious response. The oil shock, Iran's potent retaliatory weapon. The primary and most devastating form of Iranian retaliation would be against regional energy production and shipping. An attack on the Strait of Hormuz, the narrow choke point through which about a fifth of the world's oil and a fourth of its liquefied natural gas flows, represents the biggest potential oil shock. A doubling of oil prices, a very real possibility if the strait is severely disrupted, typically precipitates a global recession. Even lesser shocks average a 20% increase in oil prices in the short run and a 40% increase over 12 months. Iran's influence in global oil markets, while diminished from its peak in the mid-1970s, when it accounted for over 10% of global supply, is still significant. It currently produces approximately 3.3 million barrels per day, accounting for about 3% of global supply and ranking as OPEC's fourth largest producer. Due to years of sanctions, Iran relies heavily on China, which imports roughly 90% of its crude via opaque trading networks and a dark fleet of aging tankers, often at steep discounts. These flows can reach 1.25 million BPD, meaning a disruption would force China to seek alternative supplies, tightening global markets. But the larger threat lies in the disruption to other major exporters. Saudi Arabia, Iraq, the UAE, and Qatar ship much of their crude through the Strait of Hormuz. While Saudi Arabia and the UAE possess some bypass pipeline capacity, a full blockade would jeopardize shipments of 16.5 million barrels of oil a day. Such an event would send Brent crude prices soaring, causing stocks to stall amidst profound uncertainty, while treasuries would see a significant safe haven bid. Crucially, Iran's military doctrine appears to have shifted. Previously focused on containing confrontations, senior officials like Major General Abdolrahim Musavi now warn of heavy casualties and a willingness to inflict tangible costs on U.S. forces and assets. The regime insiders' warning that Iran would move towards escalation, targeting anything within reach from U.S. bases to the Strait of Hormuz and American warships, underscores the gravity of the situation. They even threaten to hit the U.S. if Israel initiates strikes, signaling a complete removal of previous distinctions. This aggressive stance, born of desperation and perceived existential threat, makes the prospect of a measured, surgical strike leading to a negotiated outcome increasingly remote. Regional dominoes and diplomatic dead ends. The potential for broader regional destabilization is also acute. Lebanon, for instance, has received warnings that its civilian infrastructure, including Beirut Airport, could become an Israeli target if Hezbollah intervenes in an Iran-US conflict. While Hezbollah's military capacity was significantly degraded in the 2024 war with Israel, it remains a potent proxy that could be drawn in if Iran faces an existential threat. Diplomatically, the situation is fraught with peril. Trump's negotiating team, including son-in-law Jared Kushner and envoy Steve Witkoff, lacks deep experience in Iranian affairs, and his messaging on objectives, whether seeking to merely curb nuclear ambitions or achieve full regime change, has been mixed and unclear. Despite a massive U.S. military buildup, the largest since the 2003 Iraq War, including 2 carrier groups and 18 warships, Iran has not made significant concessions. Top Democrats, like Chuck Schumer and Hakeem Jeffries, have voiced concerns about the administration's war aims, urging a clear explanation to the American public. Pentagon warnings about potential munitions shortages and a lack of allied support further complicate any military adventurism. In Geneva, fragile talks continue, representing perhaps the last slim chance for a diplomatic off-ramp. However, the Iranians, driven by national pride and a history of resistance, may be more inclined to fight than to capitulate, particularly if they believe the U.S. will not commit to regime change via ground troops. The financial fallout. A grim outlook. The current state of affairs paints a grim financial picture. 1. Oil volatility and price spikes. Any significant military action, particularly involving the Strait of Hormuz, promises an immediate and substantial surge in oil prices, potentially leading to a doubling and triggering a global recession. Even limited strikes would cause significant, albeit perhaps temporary, price increases.
2.
Market uncertainty and risk aversion. Equity markets would react with profound uncertainty, likely stalling or declining as investors seek safer havens. Treasuries would see a robust bid as a preferred refuge for capital. 3. Economic contraction and inflation. Beyond the direct market impacts, a sustained oil shock would feed into higher transportation costs, manufacturing expenses, and overall inflation, stifling global economic growth and potentially pushing several economies into recession. The current situation with Iran is a financial tightrope walk. The regime's internal vulnerabilities, combined with the U.S. administration's aggressive posture and Iran's stated willingness to retaliate decisively, create a high-stakes environment where miscalculation by any party could ignite a conflict with severe and widespread economic consequences. As expert financial strategists and investors, understanding this intricate web of geopolitical and economic risks is paramount to navigating the turbulent waters ahead. 3-point recap. 1. Iran's instability amplifies risk. Facing mass protests, economic collapse, and leadership succession, the Iranian regime is highly volatile, increasing the likelihood of panicked, aggressive reactions that could trigger a global oil supply shock, estimated at a 40% risk. 2. U.S. military options and escalation pathways. President Trump is weighing options from non-kinetic warfare to limited or full-scale strikes. While limited actions might cause temporary oil spikes, targeting domestic security forces or core infrastructure risks severe Iranian retaliation, including attacks on the Strait of Hormuz, which could double oil prices and cause a recession. 3. Oil shock and global economic fallout. Any major conflict threatens the Strait of Hormuz, a critical choke point for 1/5 of global oil. Such disruption would lead to dramatic oil price increases, market uncertainty, stock stalling, safe haven bids for treasuries, and potentially widespread global economic contraction and inflation. For more in-depth analyses on global financial risks and geopolitical developments, be sure to subscribe to Nexus Deep Dive.